The Japanese Debt Mystery, 2025 edition. Have you ever heard about someone who's drowning in debt, but when they ask to borrow money, people rush to lend it to them, and they even pay interest on their own money, not the borrower? Sounds like some kind of magic, right? Well, it's not magic. It's one of the strangest economic stories in the world. Let's uncover it together in the next few minutes, the story of Japan's incredible debt. This is Cyrus Vault, and let's start. Back in the 6th of March 2013, at a conference in Chicago about the future of Japan's economy, the main speaker was Kyle Bass, a famous American hedge fund manager. About 36 minutes into the talk, a student stood up and asked a sharp question. If tomorrow you suddenly became Japan's finance minister, what would be the first thing you'd do? Without hesitation, Kyle laughed and said, "I'd resign." Yes, that's exactly what he said. Then he explained why. Japan had gone through 10 finance ministers in just 5 years. One of them committed suicide. Another ended up in the hospital from stress. That's how hard it is to handle Japan's budget. But why? Why would anyone not want to be finance minister of the world's second largest economy at the time? China was third back then. The answer lies in the weird nature of the Japanese economy. On paper, their debt looks terrifying. But in reality, Japan remains one of the most stable economies in the world. This paradox is perfectly reflected in the Japanese debt story. When the pandemic hit and global supply chains faltered, the world literally froze. Planes grounded, factories closed, tourism crashed. Governments everywhere faced collapsing revenues while spending skyrocketed on healthcare and stimulus. When that happens, there's only one way out: debt. Governments issue bonds. Investors lend them money in exchange for interest. And normally, riskier countries pay higher interest to attract investors. For example, if US bonds give $10 per $1,000 invested, riskier countries like Lebanon might offer $100 to compensate for the risk of not paying back. That's how credit risk logic works. Lower risk, lower interest. Higher risk, higher interest. But here's the twist. Japan is the exception. Japan's public debt is enormous. As of early 2025, the outstanding government bonds and borrowings, central government, were around 13 yuan, 237 trillion, 13,237,155 yuan, 100 million yen. As of the 31st of March 2025, Ministry of Finance Japan, its debt-to-GDP ratio is around 236.7%, 2024, and expected to approach 250% plus by end of 2025. CEIC data, +3 trading economics, +3 Wikipedia, +3. That means Japan owes more than twice the size of its entire economy, and yet investors are eager to buy Japanese bonds. Whenever Japan issues debt, it's often covered rapidly, even crazier. In recent years, Japan's bond yields have started to rise its 40-year. Bond auctions showed weak demand as yields hit record highs, for Japan, around a 3. 675% for 40-year bonds. Reuters, +1. Also, Japan ended its negative interest rate policy in March 2024 and entered positive territory, which raises major questions about future debt servicing burdens. Nippon, what makes this story even more fascinating? The majority of Japan's debt is domestically held. More than 90% is owned by Japanese institutions: central bank, domestic banks, pension funds. Wikipedia, +2 Hey Insights, +2. The government's 2025 budget is a record 115.5 yuan trillion. Of that, servicing the national debt alone was about 28.2 yuan trillion, is approximately equal to 24.5% of budget. In FY 2025, Nippon, Japan's net external assets, that is to say, assets abroad minus liabilities, rose to a record 533.1 yuan trillion, tilde US dollar 3.73 trillion in 2024. Reuters. With yields rising and demand for ultra-long bonds weakening, Japan's fiscal position is showing new stress. Weaker auction demand, increased borrowing costs. Reuters, +1, how does Japan pull this off? Because it borrows in its own currency, the yen, and controls its central bank, the risk of outright default is low. Because most of its debt is held internally, the government owes its own citizens and institutions, creating a closed loop of debt financing. Because investors view Japanese government bonds, JGBs, as safe reserve assets, even with low or negative returns in past years, thanks to Japan's economic scale, currency control, and institutional structure. So, what's the takeaway? Japan has the highest debt-to-GDP ratio among major advanced economies. It borrows mostly from its own citizens and institutions rather than foreigners. Even as borrowing costs rise and demand weakens for long-dated bonds, the structure has so far contained crisis risk. It shows that having huge debt doesn't automatically mean disaster. The structure of who holds the debt, in what currency, and how the economy works matters deeply. If you enjoyed this breakdown and want to dig deeper into other weird economy stories, like how some countries borrow at near zero or even negative interest rates, you know what to do. Like, share, subscribe, and hit the notification bell so you don't miss the next chapter.